Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 a.m. UAE time, and the markets in Asia have been trading for half a day now anyway, and Brent has opened up a little bit stronger in Asian trade this morning. One might say generally little changed, but it's up about 1/3%. But holding firmly above 70 as last week. Obviously, we saw on Tuesday, one day in the last, I think, number of years that Brent actually opened with a 6 next to its number rather than a 7, but it has since sort of clawed back and consolidated above 70 again. Let's kick off, as always, Monday morning. Omar Najia, the global head of derivatives at BB Energy. Omar, do you think we've seen the lows of this year?
Nick, I'd love to say yes, but I think, I don't think there's a lot to do in this market right now, unless, from where we are now, I'd say, $5 either way. It goes $5 higher, it's a buy. It goes $5 lower, it's a sell. But I mean, the after the lows that we set recently, a few days ago, the market isn't exactly, raging higher. So I'm not so convinced right now. I think this market wants to break down. There's no reason for it. There's no reason for it. The market is definitely short. So positioning is short, especially on distillates, extremely short. Less so on WTI than on Brent, but managed money is basically short. And I think that, given everything that we know, given the performance of the stock markets, given the performance of pretty much every asset class, the fact that oil just isn't doing it. In fact, oil is down, I don't know how many percent this year, maybe 20, I'm not sure, but that's not a good look. So at some point, this thing is going to turn violently, and even with Fed cuts around the corner, it just doesn't seem to want to do very much. Now, usually crude, to be honest, off flows is always weak at first, but this market should be higher. But I have no trust. Basically, I'll wait. Market's trading plus or minus $69 on WTI. It gets to about 73. I think it looks like a buy. Breaks down, sets new lows, gets to 64-ish. I think basically we're heading to, a lot lower.
Let's welcome Ali Al-Riyami, former Director General of Marketing at the Ministry of Energy and Minerals in Oman. Ali, we've had reports this morning from Reuters regarding China's massive increase in storage over the course of August, adding a whopping 1.85 million barrels per day during the month of August. Still a lot of appetite for oil in buying, perhaps in China, not for consuming, but for storing. Your thoughts on the outlook for that and where OPEC Plus should go with these data points?
Well, the market is still in backwardation, right? So it is strong. It shows strong for several reasons, actually. Chinese, they are buying for their own reasons, and but it doesn't mean that there is demand for oil in China. The refineries are, they are not really intaking any more extra oil. They are just benefiting out of the price. I mean, the price when it was 69, everybody wants to buy. Even America, they bought for their own strategic stories. So everybody is getting, is using the advantage of low price, and they are using it for their own strategic or commercial storage. But are there any demand for oil is normal like it used to be last year? I don't think so. We don't see that at the moment. China, or not from China, not from Europe, not from America. So we are really facing a difficult time, although that the market, like I said, it is strong, but that is normal. People are buying and selling like normal, but there is no fundamental to support that this could be the raise of price, a week after or 2 weeks after now. I don't think that will happen this year.
Let's welcome Brian Pieri, founding member of Energy Road, based in Denver, Colorado. Brian, we've got a pretty clean handle. I mean, I just heard there from one of our other commentators, Clyde Russell, giving us the inventory numbers out of China, but generally the health of Chinese economy is clear. It's less than one the markets may want. It's less than even maybe was expected this year. But it's more or less in the space where we've all sort of come to understand it. I'm leading to the question, where is America? I think that is one question that's a little bit unclear from a demand point of view. Obviously, we're deep in the election cycle. You got Trump saying the world is going to end. You've got Harris saying, no, it's not going to end. We're getting back to something positive. But where is the health of the US economy at the moment? Where is the health in its oil demand? And how should we interpret the decision this week vis-a-vis, will it be 25 basis points or 50? Does it make a difference? Your thoughts on the health of US oil demand?
So listen, thanks for having me. And as Ali and Omar were saying, there is a lot of interdependence on the price and Chinese demand. And the fact of the matter is that the Chinese demand this year is off, and it's 3 to 5% off, and that is severely impacting the price and the overall global demand. On the supply demand front in the United States, as we've discussed before here on Gulf Intelligence, that the U.S. supply has really stabilized. It's not really accelerating. It's not really increasing. Our rigs on the supply side is static, and part of the reason is economics on the supply side are getting more challenged. They have to drill longer laterals, they have higher declines, and so it's harder to keep up. And so we have just enough rigs that we're keeping our production stable. On the demand side, there's been some strong numbers this summer on the summer driving season. However, the weak spot, and I think Omar just talked about this, there's a large short on distillates, and diesel is really being impacted and driven down. Now, when you look at what's interesting, when you look at the supply demand and you look at the stocks don't reflect an overly bearish diesel market. So the stocks are still on 5-year lows, and that goes for all products and crude oil here in the United States. And that implies that that demand is keeping up with supply, and maybe even a little bit more. And now part of that is with higher interest rates. Nobody wants to keep it in storage because it costs more to store. So I would say, from getting back to your original question, the health of the economy is severely in question. The health of the economy in the U.S. has really been floated on a lot of debt, and some of that has been consumer debt, some of that has been government debt, and that has kind of floated things up. And I think Omar mentioned it last week that what's confusing about oil markets is every other market seems to indicate a very positive indication on whether it's gold, whether it's other currencies, whether it's stock market, but oil is just stuck in the doldrums. And I think that may be the leading indicator of severe economic challenges for not only the US, but the globe.
Omar, just coming back to that central team, obviously this week, if there's probably the biggest data point to land, is the Fed cutting rates, and the question, and the markets have been tug of war with this for the last week or so. Some days it feels 25 is the number. Some days it seems 50 basis points is the number. At the moment, this Monday morning, it feels like the markets are indicating strongly towards 50 basis points. But my question to you, does it matter to the oil market's direction in the short term how much or how big this cut is this week?
No, it doesn't matter. And I think basically the Fed I'd be shocked if they cut by 0.5. I think they cut by 25 basis points. But the point is that they're going to cut. The point is that everybody knows that the Fed is going to cut, and the reason why they're going to cut is because treasuries need to borrow money. And there's lots of stories about the fact that they're paying over $1 trillion in interest rates, in interest payments, basically, so more than their defense budget. That's unsustainable. Will they need to borrow more money? 100%. Will they need to borrow more money at accelerating rates and accelerating pace? 100%. Their deficit is growing by $1 trillion every 3 months. I mean, it's mind-boggling. Every 100 days, the U.S. debt increases by over $1 trillion, by $1 trillion US. So I think there's definitely a problem. So I think basically what you're going to see is cuts in interest rates, inflation going up. Now they'll massage it and say, look, we're not really looking at food, we're not really looking at gasoline, we're not looking at any of that, and we can cut and everything will be okay and all the rest of it. But I think the markets are crying out for cuts. They need liquidity, and that's if the Fed has a toolbox and they open it up and they look inside, all they see is liquidity. There's nothing else. So there's no like a spanner, a hammer, a screwdriver, a plane, a card. There's nothing. All there is print money. That's it. So and that's a fact not only in the US but also to an extent in Europe. The only solution that they have is more liquidity, and they're going to bring that to bear. I think they cut 25%. I think you see markets rally. I think you see the S&P rally. I think you see commodities rally, big time rallies from where we are. And you see basically risk on assets, because nobody wants to hold money in the bank, rally. What do you call it? Real estate, anything that's real, and everybody's going to buy everything, because you can't keep your money in the bank because it's going to go to zero eventually. It's been going on since the Second World War. Debasing, used to buy a burger for 10 cents, now it costs you $10, right? And it's going to keep going until basically they debase it completely, hence the rise of gold and silver and platinum and Bitcoin and all this kind of stuff. So it's
oil at $70 is dirt cheap.
Oil is dirt cheap, but there's a big short in the market. Notice how every time this market rallies, it gets smacked down. And then basically they try and push it underwater, but it just doesn't want it. Comes back up, and then they smack it back down. Why? I have no idea. Strategically, if you're saying to me that's the market view, yet strategically people are putting on shorts, I'm mystified. Now, having said that, I was bullish when WTI was trading at 80. I was bullish when WTI, I thought, once we broke 90, we're going to really go. But every single time they've sold it, and I sold it heavily. What Brian was saying was right. It's been distillate. We do a lot of like gas oil cracks. They've been hammered. I mean, we were looking for the market on distillate cracks. So the difference between Brent and gas oil, that was going, it went down to 20, 22. So we bought it. It went up 26, something like that. Then it cratered completely. We bought it again. It went up a little, and then it cratered. It's trading at $15 for Q4. I mean, I don't know what message that's sending, but it's the message that I get is, if you buy it, we're going to sell it in your face, and you're going to be wondering why the hell you bought it and what the reason is. I don't know what the reason is. I have no idea. And again, if you look at the open interest, the managed money stuff, gas oil is negative, heating oil is negative. They've been hammered. Why? I don't know. Now, yes, if you look at the market structure, food is backwardated, but it doesn't make sense. The problem we have is a refining problem, not a crude problem. So basically, if you look at the market and you're bullish, you look at crude, you say it's backwardated. Okay, good sign. You look at distillates, they're messed up. So, and the problem should be on the refining side. In other words, we can't make enough stuff because our refining capacity is dwindling as time goes forward. So it's extremely confusing. This is why I'm saying sidelines.
Ali, OPEC Plus can't afford to stay on the sidelines, really, in a sense that obviously they decided last week to abandon or suspend their decision to raise supply from October 1st, which of course includes Oman. Was that a bit too little, too late? Or should they have gone more and said, okay, we're not going to increase it for the next 6 months, not just 2? Or what's your thoughts on the cards that OPEC Plus still has in their hands to play? Or have they played all their cards? Your thoughts on the OPEC Plus strategy now?
Do they have any more cards? I mean, they have played all the cards. I don't think they have anything else. But there are two schools of thoughts. One school of thought says that why did we announce in June a roadmap to end of 2025? Why do we need to do that? Why do you want to show everybody that we are going this route? Although that His Royal Highness said we can interfere anytime, we can change the decision anytime, but you have already throw out all your cards. You have you show the world that this is my roadmap and this is how much I'm going to do on a monthly basis until 2025. So that's one school of thought. The other school of thought is say that we can interfere anytime, like we did this time. Okay, we delay the decision for 2 months, and we can do that again in December and delay it again. But to me, I am coming from the past school of thoughts. Why did we have to announce and to make it clear to everybody that this is how we are going to do it? I mean,
well, now that's already done, right? That's in the past.
Exactly.
What do we do from here?
So that's why I'm saying, I mean, there is no more cards to play. I mean, you have shown everything, you have finished everything. Now you just.
They could announce they reverse all their plans for increasing next year are abandoned. I mean, that's a pretty big card, isn't it?
Yeah, but
rather than wait 2 months and 2 months and 1 month.
And that is what they're going to do. I mean, now they have delayed for 2 months, and they come December, they will of course review the market again, and they will see that maybe after 2 months or 3, the things will get better, and then they will start deferring it again for another 3 months. That is not the way. I could have seen a different thing happen. I mean, right, Sean, you are right. They can defer the whole thing and say that we will continue cutting until end of this year, period. But why did we have to show the world that this is how we're going to do it? And then we come December and we change our decision. I mean, I would prefer to wait on a quarterly basis and review the market and take a decision accordingly, rather than making it obviously to everybody. But anyway, that is the decision, and I respect His Royal Highness, views and ideas and interference. We are part of the OPEC.
Well, he's done an amazing job up till now, guiding the ship. So this is more challenging, perhaps. Brian,
absolutely.
You were one of the few and called it spot on that you didn't expect to see any growth in U.S. oil production this year, and you've been proven right. And I'm wondering, to add that to the other point you just made, that with the higher cost of money now starting to decline this week, 25 or 50 basis points, will that start to move the dial for some American U.S. oil producers to put more money in the ground to start to re-energize U.S. production?
Well, I think that's when you start to step back and take a look at the broader approach. So what happened during the shale revolution from the mid 2000s, 2005, 6, 7, is a lot of independent private equity venture capital money went into particular basins such as the Permian, such as Marcellus Utica, to prove up particular plays. And what happened is these were proven up, and then they've been acquired by larger companies. That's what's been happening over the last couple of years. You see some of the larger companies like Exxon, Chevron really taking hold of very, very, very large positions in these plays. The Permian, since we're talking oil, the Permian is what we'll focus on. The Permian has been acquired up into these larger companies. Now, when it previously was held by a private equity company that had a Permian position, they had two options. I can drill for more oil, or I can sit on money. And so they had two options. Now it's sitting inside of Chevron, Exxon, and Chevron and Exxon are like, well, I can drill in the Permian, or I could invest a little bit more in Venezuela, or I could look at this other international project. So the thing is that I think these plays are going to slow down a lot. And you can see it, the Permian rigs has been virtually the same this year. Part of the reason that I held that position that we're not going to see oil growth is based on the number of rigs. Because we are dropping during 2023. After 2022, we just saw a steady drop, and it takes time for the drilling and uncompleted wells to be brought online to really see the impact. And that's why I was saying,
But isn't there been a general understanding that even though the rigs have remained sort of flat, if you like, in terms of numbers, but the ability of each rig with new technology to draw more oil out of the ground is the new sort of growth area? That, I mean, that's sort of the general narrative, but you're saying not so much.
Well, you are correct. The rig efficiency, the volume of oil that comes out per rig has increased, and it's increased over time. Back 10 years ago, that increase year over year was a 30% gain year on year. We've now flattened to where it's like a 7% gain versus last year. But now we're producing more oil by drilling longer laterals. So what that does is it increases cost, it increases the volume of oil, but there is a correlated increase in cost of drilling the well. So there is a perceived rig efficiency gain that people keep looking at, and they say, hey, our rig efficiency, our oil per rig has gone up 20%. Well, there's been maybe an 18% increase in cost. So it's not one-to-one of, well, we haven't really improved. We've improved 2%, not 20. So the thing is that those decisions are now coming into play when capital budgets are being formed, like for 2025. As a matter of fact, when I expect capital budgets to come out for 2025, especially given where oil is right now and natural gas, I don't expect a lot to be, I don't expect an expansion out there, which means from the supply side, it's going to be very supportive. But it points us back to what is the demand side going to be? And that's where all eyes sit on China. India's been a great growth story, but it just can't pick up the slack of what China's dropped. So hopefully that answers it.
Let's go to the survey question, which is touching on this point. What size of Fed rate cut this week would be more bullish for oil prices? 25 basis points, 50, or no impact on oil prices for either of those? 25 basis points would indicate, okay, the economy is pretty good, but we don't need to take drastic action. So that's a good outline. 50 basis points feels like, oh my God, is there a cliff we don't see here? The Fed has a view on a cliff that we're coming up to. That would seem kind of scary. It seems kind of bearish, perhaps, to me, the bigger it is. But I mean, then
they might scare the market that way.
You know, the cheaper the money, maybe then, of course, it drives the investment. And so where do you go on this? I mean, that's the choice I'm asking to get some sense of the room, and we'll put it out in social. No impact on oil price, obviously, is one option. In all of this, Omar, the what's happening, and you've been calling it for a while now, the dollar weakness with the declining rates. We're seeing the dollar already. There's a big, the biggest sort of long on yen for a while, and yen's already at a 140 or something. But the dollar weakness is the next sort of outcome here in the short term, Omar. Lower rates, dollar weakness. Is that good? Is that bad for demand, for the direction of travel? Weaker dollar, lower price of money?
Yeah, I think basically that's inevitable. So again, the US dollar is suffering on multiple fronts. One, they're printing more. They're going to need to print a massive amount more. And apart from that, they have ginormous debts. And whoever comes into power, guaranteed, is going to do one thing, which is spend more. Nobody's going to spend less. That's not a vote win. So you add it all together, that's negative for the dollar from the US point of view. From the rest of the world point of view, very few countries want to hold as much dollars as they did in the past. They don't want to do it. They don't want to do it because they can get sanctioned, they can get this and that and all the rest of it. So they don't want to hold it. They're also seeing the rise of the BRICS. They're also so all in all, the world is de-dollarizing. Yes, it takes time, but these things have a habit of surprising, i.e. trends start slowly and then basically accelerate, and people say, oh, I thought it was going to take 10 years or 17 or 5 or whatever it is, and they tend to kind of happen really suddenly. So basically, when do people lose when does the dollar accelerate to that degree is basically when the treasury can't sell debt. And I think we're getting very close to that point, which is why they talk about stuff like, Tether buying treasuries and all this kind of stuff, because the Indians don't want it, the Chinese don't want it, the Russians don't want it, the US banks have plenty of it, and there's still more to come. So when the US dollar will have a problem, and the other thing, notice how all the debt that the US is selling is not 5 years and 10 years and 30 years. No, because even less, nobody wants that stuff, because you get whatever it is in interest in 30 years' time, your money's worthless, however much what the coupon is. So all their debt is being sold at the front end of the curve, a year, 3 months, 6 months. That is not a vote of confidence in the dollar. That is a vote of, shit, I don't know what to do. Give me a few pennies while I decide what I can buy. So all debt issuance now in the US is right at the front end of the curve. And that's a negative thing. And I think that'll continue, that'll get worse. So yes, I'm negative the US dollar over time. And I'm not talking, weeks or days, I'm talking months and years. Nothing moves in a straight line, blah, blah, blah. But trend-wise, I expect the US dollar against other fiat currencies to go down. I expect the US dollar versus pretty much anything, whether it be wheat, corn, gold, equities, house prices, blah, 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 to decrease. And I like to use this thing at the Weimar Republic, where to buy a loaf of bread, you had to take a cart of cash with you to the bakery. During that time, the German stock market was going vertical, right? It's just that the value of the cash, the money, the paper became valueless. So you don't want, when the music stops, you don't want to be caught having money in your bank account, because they're going to take it all, right?
Ali, let's just close this out. Ali, I wanted to get obviously a temperature take, because on the fiscal impact of 70 Brent versus 80 to 90 Brent for regional economies, obviously Oman being a critical one. We're already seeing Saudi carry fiscal deficits this year. Where do you think this lower price range, if it holds in and around 70 rather than 80, although the average for the year to date has been 80 or 80, a little bit plus. But obviously, as we trend to 70, that's coming down. But I'm wondering, from a fiscal health of the region, how this is going to play out.
Very bad, Sean. I mean, countries like Saudi Arabia, like UAE, like Kuwait, they are more, impacted than Oman. I think we are always been very, very conservative when it comes to oil prices, and we normally go much lower than the reality in terms of oil price. So this year, as an example, we priced on $60, and we are still on 70. So we are doing fine in terms of budget-wise. But the deficit, of course, I mean, the break even for Oman, I think it's on 80s. Saudis, it is more than 90s. So it depends. It varies from country to country. But when it goes to 70, then most of this budgets and also fiscal years are being affected. For Oman, let's say we are starting during this time, this period, to start talking about next year's budget. And they are thinking about the same, 60 to 55. So we are very conservative, but I think it is bad for countries like Saudi Arabia, countries like Kuwait and UAE, those, countries that they spend a lot, especially Saudi Arabia. They have to realize that the $70 price of oil is not really a good price for them, and I'm sure that they will try their best either to delay the decisions to bring back the barrels, or to do something to allow the price of oil to go up. So I'm optimistic for next year. I think the price will be better than 70. It may reach to 80, 85, like we did this year at least. But the fundamentals has to be stronger than the fourth quarter of this year for the prices to go up next year.
Brian, last word to you. I mean, the other option, there's the survey result, 50 basis point would be the most bullish. But the other option,
right. Yeah,
Brian,
50 basis point, yeah.
Yeah, the other option, Brian, for OPEC Plus is to stick with their plans to raise supply, and that way tolerate a lower price for a while to squeeze out the higher cost producers that sit not too far from where you are. At this price or lower, how does that impact not only the adding production, but maintaining current production? Do you think that it would start to have a downward push on oil production in the States at these levels or lower?
Oh, it definitely would. I mean, the fact of the matter is that if that were to happen, since there's been this transition from single basin pure play owners to these mega larger plays, Chevron, Exxon, they're just like, well, I guess I'm going to go spend my money in Venezuela. I guess I'm going to spend my money elsewhere. So there's just not going to be growth. And then the declines really catch up to where if you removed rigs right now, I mean, we would lose 30% of our crude oil production in 1 year. So, I mean, people don't realize, well, if we're at 13 million barrels a day, 30% of it disappears after a year if all our rigs went to zero. Now, we're not going to go to zero. There is going to be some maintenance rigs out there. There's going to be some rigs at work, but that would put a lot more strain. And part of the reason that we're virtually the same level that we were in October is because we've had about 300 rigs working in the Permian, and that's just enough to offset the decline, that 30% decline. So I think if that were to happen and OPEC Plus were to release, I think it would impact U.S. production, and that would decrease significantly. Now, what that would do to the balance of the market elsewhere, I don't know. There's a lot of barrels offline because of OPEC Plus compliance. So the fact of the matter is, I don't know how much of a difference that will make in the end, at the end.
Well, we need to wrap it up there. I mean, I think it's certainly something that OPEC Plus could be entertaining. Maybe it's a good time to squeeze some of the higher cost producers out of the market who've been enjoying such a free ride for a number of years. At some point, they've got to call the bluff on those and stop, I would think, giving up the market share, especially when their own production is having to remain cut. Anyway, one of the things to think about along the long list, Brent crude oil this Monday morning trading at just under $72 a barrel. Will it hold there through the week? We'll have to wait and see as we move closer and closer to the big Fed decision. Thank you, as always, Omar Najia, Global Head of Derivatives at BB Energy. As always, Monday morning isn't the same without you. Brian Pieri checking in from Denver. Really appreciated Brian, founding member of Energy Rogue. And of course, the one and only Ali Al-Rayami, former Director General of Marketing at the Ministry of Energy and Minerals in Oman. Very clear and useful and impactful voice. Thank you, Ali, for joining us back at the table here. And look forward to seeing you all in Fujairah on the 1st of October. Take care and have a good week.
Thank you very much.
Thank you, guys.
See you guys later.
All right. See you. Bye.
Bye-bye.